The venture capital is the only space in the financial intermediary industry where there's a very clear indication of alpha, especially among the top venture capital funds.
Dear friends, ladies and gentlemen, I would like to announce today a new series of our podcast, Ventures from the Valley. I'm Victor Orlovski, and this podcast is presented to you by R136 Ventures. Today we have our guest, Professor Ilya Strebulaev. Ilya is the David S. Lobel Professor of Private Equity and the Professor of Finance at Stanford Graduate School of Business, where he was a faculty member since 2004. He also serves as a research associate at the National Bureau of Economic Research and in the founder and director of Stanford GSB Venture Capital Initiative. Hi, Ilya. Welcome to the studio, and thanks for being with us.
Victor, it's great to be here. Thank you for the invitation.
So let us start with the first question, Ilya. So you decided to study venture, right? So, and it was long ago. So for almost 20 years, even more than 20 years now, we're approaching 2025, you're studying and researching and teaching venture capital. So why did you decide to study and research venture capital, which was very small, fragmented industry back in 2004, probably existed only in a small spot of land between San Francisco and San Jose. So what was the reason to choose it back then?
Victor, first of all, you're absolutely right. When I joined Stanford as a young professor of finance back in 2004, the venture capital industry was very, very small. And I would say from the point of view of big financial intermediaries or the big financial system, both in the United States and globally, relatively irrelevant. At least most people thought so. Indeed, when I came to Stanford, I thought so too, or to be precise, I didn't know much about venture capital. You know, in the world of academic finance, the venture capital was not studied back then. The reason I became interested in venture capital early on, because I was teaching a lot of my students who became either startup entrepreneurs or became venture capitalists. And now, Victor, I did not teach them venture capital in 2004. I taught them finance, how to make smart financial decisions. And then what I realized pretty quickly is that my students went on, and if they became chief financial officers, chief executive officers of large companies, they would follow my tricks, my rules, my principles, what I taught them. But if they became venture capitalists, they decided to ignore almost every single rule I taught them. So I decided to prove them wrong and decided to study the venture capital process. And in doing so, I proved them right, which more or less, I decided the venture capital is a very unusual space in at least two respects. First is how venture capitalists make decisions, which is very different from traditional financial decision making. And I quickly realized that the way VCs make decisions has been not really studied, and it's relatively underappreciated, unknown, even among VCs, but definitely among VCs outside Silicon Valley. And so I decided really to study how venture capitalists make decisions and all the aspects of the VC industry. But there was something else. And something else I think is really important. And again, it took me a while to understand that. And I think now this is now something that many people realize, that the returns on venture capital investments, either if you're a venture capital investor yourself, or if you're an investor in venture capital funds, is relatively uncorrelated over long periods of time with the rest of the market. Or as we say it, venture capital investment.
And it shows it to be kind of a good side of the venture capital. So it's not correlated with the markets, right?
Right. I wouldn't say it's not correlated at all, but it's correlated less than many other assets. And yes, it is good. From the finance point of view, we would like to diversify. We would like to invest in assets that potentially can provide high returns, but at the same time have relatively low systematic risk. And that is what venture capital returns are. Now, in the 20 years that I studied venture capital, I identified a lot of other things that are different between venture capitalists or venture capital industry and other financial intermediaries. Let me give you just one example, Victor, which I think is really interesting. In the finance world, the critical element is what we call persistence. And persistence means if I invest in a fund manager and that fund manager performs really well, what is the probability that that fund manager will perform well as well next year or next quarter? And we call it alpha, right? Yeah, we call it alpha. And in the world of mutual funds, hedge funds, a lot of other financial intermediaries, there is no evidence of alpha's existence. It doesn't mean that alpha doesn't exist at all. There's no evidence. The venture capital is the only space in the financial intermediary industry where there's a very clear indication of alpha, especially among the top venture capital funds.
So does that mean, Ilya, that every manager who performed well in his first fund will almost guaranteed to perform well in all his subsequent funds? Or you encountered cases where it didn't work that way? I mean, were there any famously known VCs in the Valley which actually didn't perform that well in the series of their like new ventures? Or this is like really consistent? So I would have another question. I mean, there are like some really big VCs, like famous VCs. Are they always the winners? But we will come to this.
Yeah. Well, first of all, I wish it were true that if your fund performed really, really well, then your next fund is guaranteed to perform well. Unfortunately, that is not the case. What persistence really means is that on average, probabilistically, the next fund of an overperforming venture capitalist is more likely to be overperforming as well. Okay? So the world is uncertain. We, of course, do not really know whether your fund is going to perform really well. But if let's say you're in top 10%, okay, of all the venture capital funds in this vintage, and then the same fund manager, which is important, the same people, raised another fund. So randomly, it will just 10% that your fund is going to be top 10%. The evidence clearly suggests that your probability is going to be substantially larger than 10%, but of course not 100%. So there's still a large component of randomness. But if you're an investor, Victor, then any alpha, any probability more than a random chance is a very good signal. It's a very welcome, I would say, very welcome probability.
So let's go straight ahead to this point you mentioned. Why is that? I mean, did you find like a secret sauce? Why those who performed better in their first funds are performing better in their subsequent funds? And we obviously know that the story, like the end game for venture capital is tailwind, right? Sometimes you can just win because of luck, right? Some people would call it a magic or a golden touch, but this is just luck. So you found like something really incredible, and there were cases like that. So we know all that there were many investors, major investors, who passed on Google, right? Didn't believe in Google, who passed on Nvidia, who passed on many other great companies. And those who didn't, who actually made the bet and won, became famous and became very successful with this particular deal, and then continued on with like better results on average than other funds. So is there anything else than just the luck? So what's the secret sauce of being successful in subsequent funds, not the first fund?
Of course, that is a $1 billion question, or maybe $1 trillion question these times. There are several reasons why there's a non-trivial persistence in the venture capital industry. The first reason is very important for investors. Unlike many other financial intermediaries, such as hedge funds or mutual funds, the venture capital industry is not easily scalable. which means that, let's say you raise a $250 million fund, and let's say your performance is amazing. Now, if you were a hedge fund, what would have happened is that you just raised more money. Now, if you're a mutual fund manager, an open-end mutual fund, you just would receive a lot of cash inflows, and you would manage a larger fund. And what we know is that with scale, it's much more difficult to get positive returns. Okay, there's an inverse relationship between scale, size of the assets under management, AUM, and returns. In the venture capital, for a number of fundamental reasons, you cannot scale. If your fund is very successful, you can maybe raise your fund from 250 to 400 million, but it's unlikely that you will raise it to $2 billion right away. So scalability, or the lack of the scalability, is one critical component. The second component is the access to the deals, access to the pipeline. As many VCs know, what you really have to do is to identify great deals, meaning you need to have access to them. You need to do the due diligence, or then you need to win the deals. And while due diligence is something that I think is a critical skill, but it can be learned, getting access to deals, getting introduced to deals, and then winning over the deals is something that is a repeatable business where branding is important. Many of my, let's say, Stanford students who are raising venture capital money, very often they go with a more prominent venture capitalist, even though the terms, not co-investing, as founders. So let's say we have my student who is a founder and raising money.
Founder of a startup. Founder of a startup, not of a venture fund.
Founder of a startup. That founder of a startup will take money from a more famous venture capitalist, even though some other venture capitalists, maybe lesser known venture capitalists, offer that founder better deal. As a result of this, there is a lot of luck in the venture capital industry, but as I said, luck creates skill. So that if you're lucky, and if you're lucky again, then this by itself creates a brand. And you can use this brand to get access and to win better deals. And then if you're doing the due diligence the correct way, you will be able to identify, on average, like startups with a much higher probability of success. And by the way, it is possible to identify startups with a high probability of success. And I've been doing a lot of research on that.
Yeah, we will come to this. So founders prefer successful venture funds. So if I'm a founder starting up my own startup now, I would prefer to take money from those who already have shown winning cases, right? So say ABC, I don't want to mention any particular fund, ABC fund that made great returns in the specific field which I'm entering now is probably a better fit for me. So I will first apply to them. And if they don't give me cash, I will go to number 2, number 3, number 4. So it is also important that founders select successful venture funds, not that venture funds select successful founders, right? So you are to be the first in line. So if you're the first in line, you just have a better chance to win, right? Because you do your due diligence first, and then you say no, and then an average startupper should get a response from around 200 VCs, right, to have his or her first term sheet. So if you are the first one who were approached, you probably are the potential winner, right? That's how you create alpha in a way, right? Maybe let's switch a little bit to regions of venture capital and why this capital was born and raised in Silicon Valley. I recall that for around 30 years, probably, this was only Silicon Valley play, right? Nobody did have any venture capital infrastructure through the end of 20th century, right? So it was very specific to Silicon Valley. Why it happened? Why Silicon Valley became this venture capital motherhood, if you will?
Well, first of all, Victor, you're right that for not 30 years, for 50 years. Silicon Valley, broadly understood, between San Jose and San Francisco, including kind of the Bay Area, took about 50 to 75% of all the venture capital money. And even today, even though there is more diversification, so to say, and there are other innovation hubs appearing in the United States, we clearly see that Silicon Valley is still at the forefront. It still easily takes, I would say, 30 to 40% of all the venture capital money. So it's been I would say in the US. Globally, it takes less than 30 to 40%, but it's definitely by far number one global innovation hub still. Now, why that is the case? First of all, it's very important to understand, Victor, especially for regulators that are listening or viewing us right now, there is no one factor. And I'm trying to emphasize that because I've been working a lot with the regulators around the globe that are trying to recreate Silicon Valley in one way or the other. And it's been very fashionable these days. And they're trying to learn how can they do so. Very first lesson is, do not try to identify one factor, try to identify multiple factors. You will not need to recreate every single one of them, but you need to understand that there's a mechanism. There is a number of factors that make this successful. So let me list several that I think are very critical, okay? The first critical factor in Silicon Valley is the critical mass of talented people. And this critical mass of talented people are both those that work in startups and those that work in large companies. So in Silicon Valley, there are a number of large companies, and we know those companies today, but even 30, 40, 50 years ago, there were a number of large companies that produced the critical mass of employees, and those employees had a choice to leave those large companies and start small startups. So that is the first factor. The second factor is the critical supply of funding, because if you work in a large company today, okay, outside Silicon Valley, unless you have a very bright idea, unless you're prepared to move to another part of the globe, very often you cannot leave the company and raise funding for your startup. So in Silicon Valley, there is a supply chain of funding from early seed to late stage. The third very important factor is the university system. So in Silicon Valley, there are two major universities. Of course, there is a Stanford University, where I'm speaking from, and then there's the University of California at Berkeley. And why it's particularly important is that, first, Silicon Valley is about disruptive innovation. And while the nature and the verticals of disruptive innovation, have been changing over the 50 years, they're all associated with the new stuff coming out of academic environment. And then it's being applied practically, okay? Think about internet that appeared for the first time in an academic environment, okay? Stanford especially became early on the beating heart of Silicon Valley. And by the way, behind that is not just Stanford as a great university. There are other fantastic universities, both in the United States and around the world. The uniqueness of Stanford is that very early on, Stanford aspired to two principles. The first principle is that the Stanford leadership encouraged Stanford faculty and Stanford staff to go out and commercialize their inventions, which is very important because in so many universities around the world that I've been working with or exploring, their faculty either do not want to commercialize, so do not want to go outside the ivory tower walls, or they cannot. They cannot because of the existing regulation or because of the existing cultural norms or formal rules imposed by the university. And another critical factor behind Stanford's success in Silicon Valley was that from early on, Stanford was built on interdisciplinary grounds. So meaning that, for example, an engineer at Stanford could work with somebody from the medical school. or a computer scientist with somebody from the Department of Economics, and so on and so forth. Okay, so those are three out of many factors that I think that every single regulator around the globe would like to explore: the critical mass of talent and how to create, support, retain, incentivize that talent. It's the supply of funding. And this is not just the amount of money, Victor. This is very important to understand. It is how the entire ecosystem of funding is designed. And finally, education, the higher education, but not just creating a university. If you just create a university and decide to allocate 10, 20, $30 billion, seems like a great idea. But just by designing the university, the universities will not become a hub of innovation activities. In fact, most amazing universities around the world are not hubs of innovation activities. So you need to design this properly.
So probably, like, speaking of Silicon Valley, Ilya, nobody has designed it that way, right? It just happened to be, right? It happened to be that way. So it happened to be that so many talented people across the world are coming, have been coming to California for so long, competing, but also, you live in the Valley for long already, like over 20 years. I live less than 10 years. But what I can say about California, when I just landed in Silicon Valley, even like the first day, I never felt myself to be a foreigner, a stranger, an alien. I was accepted, adopted on all levels, was welcomed by every person, by every community, which was amazing, really. And that was an amazing experience. I don't think you would ever have this experience coming from whatever country to wherever. You would still like have some barrier to entry, right? Here, there is no barrier. So I think that Silicon Valley is really amazing in that respect. So diversity of cultures, diversity of mother tongues, accents, mindsets, everything, and everyone is like welcome to come and stay as long as he or she can show his talent, passion. Yet, without like Stanford and Berkeley, this place would never become Silicon Valley, right? It will just become something else, probably. So maybe like coming to like place number two in the US, what would you think of like place number two emerging? And also maybe just to give some sense of Silicon Valley was probably 80% of the market 25 years ago, maybe even global market of the venture capital. Obviously, venture capital has increased tremendously since then. And we saw like giant funds like SoftBank, but there are many others that raised like billions of dollars, which was unprecedented. I think 20 years ago, nobody would think of raising that big funds, right? So, so Silicon Valley, in that respect, lost the market share, right? Lost market share to some other places. So, what would you name number two in the US, and what would you name number two in the world? Who are the biggest competitors for Silicon Valley going forward?
Okay, good question, Victor. Well, first of all, when you say Silicon Valley is losing its market share, I would like to make sure that I correct a little bit this statement. The market share can be understood both in relative terms and in absolute terms. In absolute terms, in terms of money around, in terms of number of startups, number of unicorns, Silicon Valley has been growing kind of more or less nonstop. What happened is that the market just increased dramatically. So the market for startups, the market for venture, the market for innovation, and obviously in a very no small part, this is because of Silicon Valley's success. And so yes, relatively speaking, the market share of Silicon Valley has declined, even though it is still very, very large, both within the United States and globally. Okay. Now, your questions are about what is number two in the United States. I would say it doesn't have one answer, like unique answer. And the reason behind this is that these days it is possible to create niche innovation hubs, which could become very successful. They don't need to be super large. They could be specializing in something. They will not directly really compete with Silicon Valley in order to become, the new Silicon Valley 2.0. But they can become very, very successful in its own right. Let me give you several examples, Victor. First, within the United States. Recently, I had a good luck to go and present to the annual meetings of investors in a venture capital fund called Peterson Ventures. And Peterson Ventures is located in Utah, state of Utah. It's about a 2-hour flight from Silicon Valley. And in Utah, somewhere between Salt Lake City and Park City, is a very successful innovation hub. Now, is it comparable in size or breadth to Silicon Valley? No. But is it, along some metrics, very, very successful, and along some metrics could be viewed as number 2 in the United States? Absolutely. Let me give you an example. So let's say, Victor, you randomly pick a startup that raised venture funding, okay? And are interested as an investor. What is the probability that your investment will be an investment in a unicorn, the startup with a 1 billion plus post-money valuation? Now, in California, it's about 1 out of 72 chance. So just invest randomly. It's not a bad chance, okay, but it's, well, low or high, it's 1 out of 72. In Utah, it's about 1 out of 61. And that is a big difference. That is a big difference. So in fact, according to this metric, Utah is more successful than Silicon Valley. Okay. Obviously, there are fewer startups. Okay. There are fewer founders. There's not that much money. By the way, the reason why Utah has become that successful, okay, or rather Salt Lake City, Park City kind of hub became that successful is for very similar reasons. There's a critical mass of talent that is supported by amazing local universities in Utah. And there are a number of large companies there, okay? And there's funding. And then there's funding. Okay. Another example that I can give that I think has dramatically increased in importance is in Texas, Austin. I would say maybe 10, 15 years ago, not many people would have thought about Austin. And now Austin would be definitely among the top innovation hubs in the United States. But by the way, again, Austin we have critical mass of talent. We have an amazing university, UT, the University of Texas System, Austin campus. And now we have an increasing venture funding, okay? So, but what I would like to emphasize is that
there's local venture funds.
There are now local venture funds.
Spin-offs of Silicon Valley
it's a good question.
Just local funds, right?
There are both. There are both local funds. By the way, not just local funds, but local angel groups. But yes, there are spin-offs from, I would say, maybe branches of Silicon Valley-led venture funds for an obvious reason. Because Silicon Valley investors are also interested in investing in and providing their not just money but also know-how to startups outside, this Silicon Valley hub. And so, what is really interesting is that I've been studying innovation hubs in the United States. Is that nobody can compete with Silicon Valley, but that is not the point. You don't need to compete with Silicon Valley. You can create something where you're successful in a specific niche. Okay. In Los Angeles, for example, there is actually a very good hub for media startups, not surprisingly, given proximity to Hollywood. In New York, fintech and fashion, again, not surprisingly so. In Boston,
so you should choose your niche, right? I mean, you should specialize in something.
And within the niche, I think you can very successfully compete with Silicon Valley. Okay, so the whole point is not to try to recreate the second Silicon Valley, but to try to understand your unique advantages. That, I think, is very important. Because yes, Victor, you were right that Silicon Valley itself was not created on purpose by design, even though, in fact, there was a purpose. There was a design, for example, on how Stanford leadership approached the commercialization problem. Okay.
But I think nobody, but back then nobody really envisioned that 7 out of 10 companies, top companies in the US, like Fortune 500 top 10, would be backed by venture capital, right? So
No,
I think
nobody.
if
I'm pretty
founders
sure
of
nobody
Stanford would
envisioned
be
that.
ever asked whether this would ever happen, that they would raise and nurse companies which would be in top 10. I don't think they would ever aim or envision that, frankly.
Well, Victor, I agree with you that nobody back then likely envisioned that. However, based on all my research, I am going to envision that the future top companies in the world, not just in the United States, are all going to come from the new innovation hubs, from Silicon Valley or from new innovation hubs that are appearing around the globe. And I think that, especially for regulators, it's very important to understand.
I think so, yeah. And I believe that you're doing a great job of explaining that and helping regulators all around the world to build their innovation hubs in the right way. And well, you and I saw a lot of examples of how this was done and was not done properly, right? I mean, that people are trying to achieve something without really understanding the core and regions of this business. So I think that there is still a lot to be done on education level for governments and regulators across the globe to achieve what has been achieved in Silicon Valley so far. But maybe just to complete this question, what's globally, what you see globally? You mentioned Utah and Austin, Texas. Anything you see like globally picking up? Something like unique in some unique way?
Well, first of all, I do see a lot of innovation activity around the world. And Victor, before I name some examples, let me step back for a second and tell you that there's a fundamental reason behind this. There are two, in fact, fundamental reasons. One is that it is now easier to start a new company based on disruptive innovation. In the past, 10, 15, 20 years ago, it was actually very, very difficult. That's why people had to come to Silicon Valley to start something truly new. While today you can start companies around the world very quickly, you can scale this quickly, and you very often need much less money to start the company. So this is the first fundamental reason why suddenly we see so many angel groups. Like 20 years ago, there were no angel groups. There was no need for angel groups. Okay, because they could not really make a difference. There is another reason, another fundamental reason, which in some respects may be even more important, is that historically, at any point in time, there was maybe only one or two dimensions of disruptive innovation. There was maybe one or two industries. Like at the beginning of the 20th century, it was transportation, okay, electricity. Then it was energy, and then it was radio communications, and then etc. Today, we see disruptive innovation happening at the same time around the globe, across all the regions, in all the industries, which means that effectively many regions are either going to become less relevant from the economic point of view, or they are going to become innovative. So in fact, either you become an innovation hub or you're going to stay behind. Something that is really important to understand, okay? And I think we see this in many regions that for the past 25, 30 years have not been very innovative, especially in terms of this disruptive innovation that is really a specialty of the venture capital industry. And those...
Yeah, there are many examples, right? Like agriculture, for example, or construction, right? Massive industries which were barely touched by innovation, right? Barely scratched by innovation.
Now they are, but now they are, right? So now we see a lot of innovation in agriculture, in construction, in mining, in traditional industries, in the government industries, etc. So, there are regions that historically have not been very innovative in the last 25, 30 years. Classical examples would be, as my research suggests, Western Europe and Japan, very successful, developed countries that kind of effectively, I would say, chose, for a reason or without a reason, chose stability over growth. in many respects. Okay. But go back to your question about innovation hubs. So I observe a lot of interesting niche innovation hubs around the world. And I think that the future, again, belongs to maybe a couple of major innovation hubs, and then a lot of local, regional hubs, some of which could be very successful. But I'm going to make, Victor, an important claim, is that like in the United States, within each region, I think only one hub will have a chance to to have a critical mass. It's kind of unlikely, just because of the fixed cost of supporting and sustaining that hub, that within the same region, there could be many, or even two large innovation hubs. And because this is such an early stage, such early days, I think that we still do not really know which hubs are going to be these major regional innovation hubs. But we clearly see that the past 20 years have seen a very interesting development in China, maybe less so in the last several years. But we see that Shanghai became a very important innovation hub in China. Shenzhen became another very important innovation hub in China. We'll see what's going to happen in the next several years, because obviously the Chinese venture capital industry is undergoing dramatic, and I would say kind of sometimes difficult transformation. Outside the United States and outside China, I would say I'm very optimistic about three more regions, or at least three more regions. The first region I'm optimistic about is the Middle East and Central Asia. And one reason I'm optimistic about this is that this is the region that's been growing or has a dramatic potential for growth in the next 10 to 20 years. And at the same time, that region that includes a lot of people, a lot of countries, some of them are really highly rapidly developing, right? And very young people, and a lot of very young people. That region doesn't really have, at the moment, a single innovation hub. And again, it's not in comparison with Silicon Valley, but just in comparison with what we expect of innovation hub to be. And I think the next 10 years will be critical, kind of. Another region I think is extremely interesting in terms of innovation is Africa. So Africa also has a very young population. Africa has been, from the economic point of view, backwater for most of the last 100 years. But now it's changing very, very fast. And there are, in fact, a lot of local centers in Africa with not just very young population, very eager population, let's put it this way, to change its condition. And I think that the educational system in Africa has a potential to improve very, very fast. Another region which I think is very interesting is South America, that again, have had kind of haphazard development, but growing, very entrepreneurial ecosystem. And we've seen, for example, an example of Brazil, that the venture funding went there at some point at a large scale, which was not entirely successful, but I think it's now coming back. So all these regions that I mentioned, I think that none of them, while all of them have a huge potential, none of them developed, I would say, anything but local innovation hubs, like very, very small, very local. I think the future would belong to a number of regional innovation hubs that are going to compete with others, win over. Asia, broadly speaking, I believe in a little bit of a different situation. Historically, there has been several regional innovation hubs. For example, I would say in Asia, we're at Singapore, and Singapore became a regional innovation hub, not just for the city-state, but for a broader Southeast Asia. And the same could be potentially said about Taiwan, which also became an innovation hub. Okay, so together with China, with mainland China, there are innovation hubs. Now, will this stay the same or will undergo changes? I think it will undergo changes, for a very simple reason that outside mainland China, and outside Japan, well, most people in Asia, in Southeast Asia, live in Indonesia, the Philippines, in Thailand, in Vietnam. Okay, and so far these countries, I would say, have not yet developed successful regional innovation hubs. But it doesn't mean that it will not happen. Okay.
But as you said, there will be there will be a few regional hubs, but it could not be that every country will sustain its own, right? Or every city, every major city, because there is a critical mass to be created.
I don't believe that either every country will have an innovation hub, or even within one country there will be more than one hub, because there's a critical mass, there's a fixed cost, so to say. Okay.
When you speak of innovation, you're always associated with venture capital, right? So innovation and venture capital are kind of two correlated terms, right? You could not sustain innovation without venture capital, right? So that's maybe like an essence of innovation.
That's a very good question. That depends on what kind of innovation. When I say innovation hub, in this specific context, I really mean kind of disruptive innovation that changes its business model, innovation that creates new industries, innovation that changes the relationship between consumers or customers and businesses. And that kind of innovation, I think, is impossible without venture. That is because the venture capital industry is unique in terms of its decision making, in terms of how it's organized, in terms of risks that it can take. Okay. Now, the word innovation is broader. So let me give you an example. I mentioned Europe. Other German.
By the way, you didn't mention Europe when speaking. You didn't mention Europe while speaking about innovative hubs. So you missed Europe completely. So I assume that you are not a big believer in European innovation and venture capital overall, aren't you?
Well, again, let me give you an example about innovation. So, German automobile industry, is it innovative? Absolutely, it is very innovative. Okay, but it is very innovative in terms of the marginal innovation. And marginal innovation meaning it's exactly the same business model, it's exactly the same industry, it's exactly the same customer, but you are improving your product, your services. And I think that this is an example of what European large companies are pretty good at. Europe, as a whole, has not been very successful in disruptive innovation. You mentioned that 7 out of top 10 companies in the US are venture-backed. But also, Victor, very important to mention, 7 out of top 10 companies are very young. They're all younger than, with 50 years. But my research shows that if you go to all those large European countries, Germany, France, Italy, Spain, the Netherlands, okay, you can also include the United Kingdom there, and you look at top companies in all those countries, either none or very, very few of them will be younger than 50 years.
Yes.
And none of them
are venture-backed.
Right. So as a result of this, it is very, very difficult for European entrepreneurs to create new companies, to scale new companies, to become very successful. And I think that it's a major challenge for Europe, for the European region as a whole. Now, by the way, Victor, I think it's very important to mention Europe does have innovation hubs. Berlin in Germany, okay, Oxford outside London, Paris these days, I think, and there are some other kind of local hubs. Would I say that those hubs are as important as, and again, let's forget about Silicon Valley, as some of the other hubs, let's say in the United States or globally? From the point of the disruptive innovation, at this point, I would not say so. And my hope it will change. But for this to change, I think...
Although they have good universities, right? Probably the mindsets, there is no venture mindset coming to your book.
It's really interesting because, as I mentioned earlier, if you have a great university, and of course, Europe has an amazing critical mass of great universities. That is not enough. That is not enough because there must be a link between academic research and commercialization or practical applications.
Yeah,
By the way,
rumor says that there are still. Sorry to interrupt.
By the way, there are exceptions, Victor. One exception maybe is TAM, which is the Technical University of Munich, where this is an example where I think really kind of, I would say, goes against the overall European landscape, where I know a number of faculty members that were very successful in commercializing whatever they developed in their labs. And overall, there's kind of a very active startup scene around the Technical University in Munich. Does it mean that it has a chance to become a major innovation hub? Potentially. But for this, of course, you need to have other ingredients, not just one very successful university with entrepreneurial leaders. You need to have more ingredients, more factors behind it.
There are still more German startuppers, like German origin startuppers in Silicon Valley than in Germany, right? So most of those who start their ventures in Germany, they just move to the United States and namely to Silicon Valley. And that's how they become successful and famously known.
That is true, not just about Germany. That is true about almost every European country. My research team and I follow every single American unicorn, and we study the founders of those unicorns. And there are so many founders that come from other countries, including there are so many founders from France, from the UK, from Germany, from Spain. In fact, we published the unicorn report. So you can just type unicorn report, and I think you will find on internet, find your way to this.
I recall these numbers. I could not give a number straight away, but I recall that number one nation with like founders who founded unicorns in the United States, outside of the US, of course, number one nation is Indians, right? So immigrants from India.
Correct.
And these are first
90 Indian founders.
First generation immigrants, right? Who came and they built their fortune and unicorns out of India in the United States.
90 founders who were born in India and who came to the United States, many of them as adults, and then built companies there. Okay. And by the way, Victor, it's on the one hand, it's a great cause for celebration, both for India that produces so many amazing founders, and of course for Silicon Valley that integrates all these founders so well. But on the other hand, I think it's a cause for concern, because these 90 people came to the United States. That also means that they did not or didn't have a chance to create those unicorns in India, right? And the same would be true about European founders who came to the United States.
I wanted to ask you, since we are also investing in Israel, we have an arm in Israel. I recall that the Israelis take like the third place or even the second place in your report of founders who built unicorns in the United States, although it's like very small nation. How would you explain the success of such a small, although it's a startup nation by itself, nation being so successful in founding so great companies? What's the reason for that, if you may?
Sure. Well, Israel is a very interesting case, very interesting example. First of all, you're right that there are many Israeli founders of American unicorns. My most recent data, I believe, is 52. 52 Israeli founders from a relatively small country were born in Israel, came to the United States, and then founded a company that became a unicorn in the United States. In fact, and this is a cool finding, I think, is that had Israel been a United States state, So let's say Israel would join as the 51st state in the United States. It would be the fourth most important state in terms of the venture capital startups, after California, after New York, and after Texas. Okay, it would be the third state. Isn't it interesting? Now, why this is the case? Well, first of all, is that I think the Israel regulators back in the 1990s made a number of very smart choices about how to attract venture capital funding from Silicon Valley, how to incentivize both the venture capitalists, international venture capitalists, and local entrepreneurial scene. So I think we can learn quite a lot from the experience back then. Second, Israel, of course, has great universities, a series of great universities, Tel Aviv University, Technion, Jerusalem, Hebrew University in Jerusalem, Beersheba, Haifa University. It's a relatively small country, which means that there is a lot of spillover between those centers of academic excellence. And a lot of professors there commercialize their technologies as well. So there is a close connections between the academic centers and companies. And as a result of this, there is also critical mass of technical talent, critical mass of entrepreneurship. So those are some of there are many more factors.
And probably army too, right? Like everybody serves, and I think that they have a good clue of how to get talent through the army and get this talent nursed.
I absolutely agree. There is a number of special kind of military units in Israeli army, kind of broadly understood. Well, not startups, but founders. Yes. So most definitely many founders from Israel came from a very few select units or pilot programs within the Israeli military system.
Okay, let's speak a little bit about the future. So, credit was a single innovation that brought the entire capitalism to life hundreds of years ago, right? If there was no credit, there was no capitalism, there was no innovation brought by capitalism. In the second half of the 20th century, we had this venture capital phenomena, which brought life this breakthrough innovation, right? And we see like every second company, I quote you, that goes public in the United States is venture-backed. And some of them achieve really a lot, right? I mean, 7 out of 10, we mentioned that greatest companies, Magnificent 7, are venture-backed companies. Yet, venture capital is still very kind of a niche play, right? It's a club deal. We mentioned that. You need to be a member of a club. You need to be a member of this ecosystem. You have to be the first at the deal, right? Founder may choose not to take your money, right? I mean, it's not transparent. It's not like any other markets. It's very, very fragmented and very kind of closed club deals, right? So you could not really make a name there without knowing people, right people, being a friend of the right people. And I saw like many very successful ventures who built their fortune on just being, say, X-Man or Elon's man is the most kind of famously known, right? You're Elon's man, so you invest into every company founded by Elon, and that's how he made your fortune. My question is how this is going to be disrupted, right? There must be something else coming, right? We are facing singularity or kind of singularity in coming years, so nobody knows what's that. But still, like it's a time when humanity, probably like human being as a species, is going to change tremendously through this next wave of evolution, right? So my question is how venture capital is going to be disrupted? Is it going to be more transparent? With this transparency, might it lose its like extreme value, being so much transparent? Is it going to be more exclusive? If so, then what's going to be in like next 10, 15, 20 years? What's your prediction?
Well, Victor, it's a great question. I don't have a crystal ball. But I will make some predictions. I love making predictions.
It's especially good
venture-
before the new year. So we actually record this startup. I'm at 31st of December now, and Ilya is still in 30th of December, but it's still like the very end of the year, and it's time to give predictions, not only for 2025, but probably for next 25 years.
So let's try. Let me try to make some predictions. So these are in my opinion, the biggest trends in the venture capital space in the next 10 years. The first one, Victor, we already discussed. I do believe that the next 10 years will see the birth and scaling, the rise of some major innovation hubs around the world. Which ones they're going to be, very difficult to predict, because that really in many ways depends on the actions by regulators and others. But I think that is one trend. The second trend that I clearly see is that the venture capital industry will be democratized in at least two ways. And those ways will have both pluses and minuses. There are trade-offs involved. The first way is that, as you correctly pointed out, most investors in the world don't really have access to venture capital deals. I think that will change. That will change as the venture capital industry is becoming more global, larger, scalable. People who never had exposure to venture capital asset class would be able to invest into the venture capital for the first time ever. Not as angel investors, but as investors in effectively well-organized kind of mutual fund like vehicles that would invest on their behalf in venture capital.
So there will still be a middleman, right, between say NLP, a limited partner or whatever investor, and company, right? So do you think there will be no middleman? Because in many other industries there are no middlemen anymore, right? There is no middleman in insurance. There is no middleman in whatever in real estate, right? So will there be a middleman here in the venture business?
I believe there will be. I believe in the venture business. We will not get away from venture capitalists, okay? But again, so the first way it will democratize is that you will get access as a standard average investor to this asset class. The second way, and that will change the demand for venture capital. But the supply of venture capital, I think, also will change. And that is now being driven by the developments in AI. I'm always asked about how AI is changing the business model or the process of venture capital itself. And again, it's now easier than ever to use AI, etc., to identify new opportunities, which means that traditional networks, social networks, would over time likely be of lesser importance. They're still going to be important, but of lesser importance. Now, you can think that both of these factors, on the supply side, on the demand side, will just make the venture capital much more exciting, and likely that's going to be the case. But as I mentioned, there are trade-offs. And the trade-offs are the following. First, the venture capital industry has historically been relatively unregulated. For a good reason is that most investors were very large, wealthy, sophisticated investors. As the venture capital industry will become more open up to your average investor, it will become more regulated. As a result of this, I think that, and this is my worry, is that it might lose, at least in some corners of it, its appetite for taking risk that is really necessary for venture capital business model to succeed. At the same time, I think, and that is another trade-off, in the past, whatever one venture capitalist did, nobody else could replicate. Venture capitalists had and were very conscious that they had proprietary deal flow, meaning that they were able to see some startups that nobody else did, or they were able to see some startups, some great founders before anybody else could. I think that the future of AI will mean that the proprietary deal flow kind of will disappear, more or less, as a as the first order phenomenon.
Mm-hmm.
So venture capitalists will have
there
to
will be no
compete on
alpha,
something.
right? So alpha will be much more rare then.
I think that alpha will be rarer simply because there will be more venture capitalists. It's now will be easier to enter into the venture capital space. We already see this. There have been so many, especially on the smaller size, so many new funds, and some of them are quite successful. But obviously, just by construction, most of them will not be successful. But also means that they will be taking business away from more traditional outfits. And so as a result of this, I think that there will be more competition in the venture capital industry, and that will transform the business model of many traditional venture capital players. So as a result of this, there is going to be many more trends. Now, let me identify one trend. I know that, Victor, this podcast is very popular with the large LPs investing in venture capital funds. I think that one of the most exciting trends in the next 10 years will be investing in emerging fund managers, I think. In the past, it was very difficult to start a new fund, a new venture capital firm, for many reasons. Nowadays, it's much easier. As a result of this, once the barrier is lower, a lot of people will be starting new funds. They need support. And those who would be able to identify the appropriate business model of how to do this, to get access to fund managers, to do the due diligence on fund managers to support them, will, I think, benefit disproportionately. So that is another trend, which I think is really interesting. It's kind of started about maybe 10 years ago. And I think that some investors profited from it handsomely. But I think it's really reaching the critical mass only now.
Give an advice to an emerging fund manager, what she should do and shouldn't do, raising capital, how to make it more efficient.
Yeah. Well, first of all, and I think that is really important, Victor, my advice for an emerging fund manager is to try to get what I call a cornerstone investor. Try to get somebody who really believes in you, understands your proposition, believes in your alpha, and is willing to back you up. I think that without such a cornerstone investor, it's very difficult to get started in the venture business. And yes, you might need to share your economics with that investor, but I think that's kind of a reasonable expectation. Okay.
Are these mostly angels, former startuppers who made exits, institutional investors? Whom would you approach being an emerging fund manager as your anchor, first?
I would say that if you're a fund manager, I would approach former entrepreneurs. I would really approach LPs who specialize in emerging fund managers, professional investors who are interested in emerging fund managers, who might become interested in emerging fund managers because they have the infrastructure.
And you see it's it's evolving, right? Because, if you look into funding, funding trends for last, say, 12 months, then you would notice that probably 85% of capital was raised by top 20 venture funds, right? So it's I see an opposite trend that in professional Ps, multi-family offices, institutional investors, sovereign funds, they prefer top names. And they almost do no due diligence, right? They just put a lot of money into top 20 brands, and they ignore not only emerging fund managers, but fund managers with a little experience, right? So, it's just an opposite trend, what I saw in last 2 years at least, and it was obviously venture capital winter. But do you think it's going to change in future? There is a room for emerging fund managers?
Yeah, I think it's already. I think it's already changing, Victor. First of all, the trend you saw is correct in absolute terms. When you said nuclear winter, that means that whenever the conditions are not the best, of course, LPs fall back on something that they know, and they know the investors that they already backed. I think the smartest investors understand that the future belongs to new fund managers. And while in terms of dollars, most dollars went to existing fund managers. In terms of the numbers of new funds or the numbers of new emerging fund managers, I have never seen more emerging fund managers than ever before. And I think the smartest investors are setting up the processes to identify those emerging fund managers.
Mm-hmm. It's a good advice for those LPs who are listening to us, that you should not only watch like top 10 because of their names, but you should really identify a longer list of names and bet maybe smaller amounts, but bet on more founders, which is wise advice from Ilya and myself. Let's just get a little bit inside the venture capital. I mean, you know, probably most of venture capitalists in the Valley. You have like personal connections with them without naming any. Maybe just give one name. Mark Andreessen told me once at our like personal meeting that he is definitely not afraid of losing money betting on deals. That's like normal for venture capital, losing. But what he is afraid of is missing out a deal. He said, I quote, when I just wake up in the morning and look into like a newspaper and see a startup going public or something, and then I just realized that like 10 years ago, I spoke with the founder and I said no to him. That's the biggest fear, and that's the biggest kind of threat I see in my career. Quote by Mark Andreessen. And I think that's very fair. So through years, I understand that I'm not afraid of losing a deal. I mean, losing a deal, investing and losing, because that's a name of the game at the end. But I'm afraid of losing a deal which I considered and not invested in. Is it true for venture that it's all driven by fear of missing out? And in particular, I'm interested in this new hype, AI, Gen AI, right? So we see a lot of investments coming to Gen AI. And you can mimic to Gen AI. You can just say that you are a Gen AI company. And many friends of mine who raised money, former like Googlers and Facebookers, Metas, and from Amazon and others who just started their companies, they told me like secretly that investors even didn't look into their decks, not even digging into their technology and product. They just got money because they're doing something in AI, agentic AI or generic, Gen AI, like models or tools or anything. So name it. So my question is, I mean, obviously there was a hype of .com. There was a hype of like marketplaces, fintechs, mobility. Now we have Gen AI. So do you think it will end, this hype is driven by FOMO and will end somewhere, somehow with like epic failures? Or you think that it will be a kind of anomaly in venture world, that it's not going to happen? And if you think it will, how will it end and when?
Okay. Well, first of all, Mark Andreessen is just an example of a smart venture capitalist, because in the venture mindset, the book that I published earlier,
and I recommend everyone to read. I think that's one of the best books I read so far in venture.
Thank you, Victor. The very first chapter called "Home Runs Matter, Strikeouts Don't," which means that if you invest in a company at an early stage that becomes a very successful outlier, then you made your venture fund and yourself successful as an investor. And if you invest in a number of middling companies that maybe don't fail but kind of become relatively successful, you're not going to make a lot of returns. So as a result of this, in the venture business model, you absolutely must embrace risk. Now, in a smart way, but embracing risk to be prepared to encounter a lot of failures. In fact, and I advise a number of large venture firms, and I recently talked to a couple of them. And my conclusion when I reviewed their portfolio, their decision-making process, etc., and I was invited to consult with them because they were used to be very successful, and kind of their leaders thought that they were not very successful any longer or as they expected. And in 2 cases recently, I just went back and said, you know what, guys, you're really no longer venture capital firms. Just look at the profile of your returns. You don't have enough failures. And therefore, you don't really have, or you can't really expect to have a lot of outlier positive returns. Okay? So in terms of failures, I think it's very, very important. Now, FOMO, fear of missing out. There are different ways to think about this. I, in fact, don't really like FOMO, the term FOMO, because it has both positive and negative connotations. Yes, fear of missing out by not investing in those amazing outliers is the one that drives every single smart venture capitalist. But FOMO also could be understood in the following way, is that, everybody invests in this specific field, therefore we must invest in the same field. Okay? Well, right now it happens to be AI. And very often I think the smartest VCs are driven by conviction rather than by consensus. If everybody thinks that that is the field that is going to be the most successful, or that is the company that is going to be the most successful, well, it's maybe too late already for you to invest in. So as a result of this, you might want to invest in a different space, in a different company, develop your own thesis. About AI, I don't believe, even though AI is amazing, I think it's very interesting, I don't believe that from the point of view of the investment process, AI is very different from what venture capital industry encountered many times in its 50-year history, which is the investors realize that with a large probability, this new trend will produce several, just a few, very, very large companies, maybe new trillion-dollar companies. If that is the case, then you as an investor absolutely must invest in the space. And you must invest in the space early enough to be able to generate these outsized returns. If you are skillful or lucky enough to invest in at least $1 trillion company. By the way, I happen to share the belief that there are a number of small, young companies today, like today, December 30th or 31st, 2024, that are not yet known to the public, maybe known to a couple of investors, that will become trillion-dollar companies in the next 10 years. I do firmly believe that. But if you're an investor, if you're a venture investor, and you also share my belief, your FOMO, I think, will drive you to make a lot of investments, including maybe investments that you should not make. I think that the next couple of years will see a lot of happiness for venture capitalists. It will also see a lot of tears. Well, it will see a lot of tears for LPs who managed to invest a lot of money back in 2020, 2021. But I think it will see a lot of tears as well, because definitely some of the valuations of some of those AI companies that will not be that successful will decline on average, potentially precipitously. And I think that we'll likely see it in the next 12 to 18 months.
Yeah, I do agree with your projections. I think it will start cooling down maybe in a year from now. It will start from probably big tech, those Magnificent Seven, because probably AI expectations for Apple and Google and others would not match the reality. And then it will start going through Gen AI startups. We saw like a lot of rounds when just senior executives from famously known companies like OpenAI drop from their positions, and they immediately get funded like with $500 million in at $1 billion valuation. And obviously, venture investing is investing in people, right? But on the other front, in this Gen AI industry, there will be only few winners, right? There will be not many winners like in many other industries, right? Where scale matters. There will be probably 1 or 2, maybe 3 winners in different spaces, but not hundreds, and definitely not even dozens. So, and we see like hundreds of startups being well funded now. So I do believe that there will be a kind of a winter coming to Gen AI. It's not going to die, right? I mean, same thing happened to blockchain. People were very aggressively investing in blockchain like 6-7 years ago. It didn't materialize in any particular innovation shift, right? I mean, apart from like Bitcoin capitalization, but I still believe that blockchain is slowly but steadily eating the world, right? So this will be the same with Gen AI. It will go to the through the failures and to the plate, and will start developing from the plate, right? But again, my belief is that many of those who invest now heavily in AI are not gonna return their money, right? Only very few will return, and obviously those who do will return really a lot. So that's my prediction probably from this market. So let's go. We have to, unfortunately, so Ilya is so interesting person to speak with. Probably we'll have a series 2 of our podcast speaking more of innovation and education. So I would definitely love to have Ilya at our next series, maybe sometime in 2025. So I want to like switch a little bit to different topic here. So education. So you are teaching classes, MBA classes. So how does your student profile change over the last 20 years? Others the same? Those the same folks? Different folks? Different mindsets? Different beliefs? Different ideas? Why they come to study at a very expensive school like Stanford Business School, why they choose Stanford. So what's the shift? How you see the shift going forward? Many young people I speak with, they believe that MBA is like waste of time. Do you think it is? And if you choose to go like being a young man or man in a, like middle of her career, going to study MBA program, especially in Stanford, why would you do this?
Well, first of all, I'm biased, Victor. Obviously, I do not think that MBA is a waste. In fact, I think that the MBA degree, especially in a business school such as the Stanford Graduate School of Business, is your card to the world, so to say, to a very successful career. Now, how students changed in the last 20 years? Well, first of all, they're getting younger every year. The average age is around 26, 27. Well, when I say they're getting younger every year, Victor, there was an attempt, maybe an unsuccessful one, at joke. Of course, the reality is that the age stayed the same. I'm getting by 1 year every year.
They're getting younger and younger compared to ourselves, right?
Exactly. It's all relative. I believe in the relativity in this world. So obviously a big changing trend among my students is that more and more students experiment during their 2-year program. More and more students start their companies during their second year, sometimes even during their first year. Some of them raise money from angels, sometimes even from venture capitalists before they graduate. Or by the time they graduate, they kind of commit money from investors. Some of them actually work as interns in venture capital, private equity firms, while they're full-time students. I think that it wasn't as active a trend 20 years ago. I believe that is a big difference, so that they are also getting a lot of kind of on-the-job experience alongside their more traditional studies at Stanford. Second is that I think the school changed itself. We now offer a lot more opportunities for our students to explore, experiment with the ideas, startups, etc. For example, we have the Stanford Venture Studio, We have our what we call the garage, the startup garage, where the students can really get together in teams, get feedback from faculty, from other students, from alumni, and just get their hands dirty by experimenting with their new ideas. Now, presumably, most of those ideas are not going to be successful. Amazingly enough, some of those ideas become very successful, okay, and survive the educational processes. I would say that what has not changed is the overall quality of students. I keep careful track of all my students that I taught in the last 20 years at Stanford. So in total, I taught more than 5,000 students. And I keep in touch with many of them, and I track all of them, really.
I know that people like founder of Zoom, for example, is one of your students, right? So there must be not a few, but many very famous people coming out of...
Yeah. Well, so founder of Zoom, Eric Yuan, did graduate from our Stanford executive program. So I'm too young to be his professor, in fact. But for example, the founder of DoorDash, in fact, the founders of DoorDash were my students in my venture capital class at Stanford, okay, as many other unicorn founders. But I think more importantly is that what really has not changed is the quality of the students. I'd say that every single time I teach, I'm really excited because I know that I am going to meet, on average, amazing students. The right tail of students is truly kind of, spectacular, out of this world, so to say. So I'm enjoying meeting with them, not only in the classroom, but outside the classroom as well. I typically meet with all of my students one-on-one to discuss their future, sometimes their startups or their career advice or whatever they want to talk about. And I'm never disappointed. I'm never disappointed in any single class that I taught at Stanford. I just hope that the next 10 years will be the same, because I have very high expectations for my students.
Thank you. Okay, so let's wrap up with the last question. Obviously, being at the end of 2024, and our listeners will see and watch this in the beginning of 2025. So they're all interested in predictions, and we already gave enough predictions for next 20 years or something, 10 to 20 years. What would your predictions be for 2025 in terms of, obviously, you're following closely innovations of all kinds. In terms of innovations, and I mean breakthrough innovations in whatever industries you think, and what may go wrong with venture capital in 2025. So I personally see the light at the end of the tunnel here. I think that 2025 will be a very successful year for venture business overall, because IPO market is picking up. M&A market is picking up, but still there might be some risks. So I would want you to focus on those risks rather than opportunities. And three most significant breakthrough innovations you would expect to come.
Okay, a lot. So I already mentioned a couple of things. I do think that there will be difficult times for many fund managers who invested a lot in 2021. At the height of the market. It's now going to be 4 years after 2021. I don't believe that valuations will improve since 2021. And if you happen to make a lot of investments, then you'll have a pretty difficult year, I think. Second is that I believe that there will be a lot of spaces that will come up, will be new spaces. We talked about AI, we talked about generative AI, but I believe there will be new spaces in biotech, in robotics, in educational technologies, in government technologies, that will become, I think, will produce a lot of interesting startups and a lot of interesting investments. I think that the next presidential administration almost ensures that the crypto space will continue to be of interest. So this will not be just the AI-dominated space. In fact, I predict that there is a pretty high chance that by the end of 2025, the valuation of some AI companies might decline. Now, in terms of the liquidity events, I do have high hopes for the IPO market to pick up in the second half of 2025. Even though if I were to place bets right now, I would place bets really for 2026 rather than 2025. I definitely don't think that it will happen in the first half of 2025, but it might in the second half.
Okay, Ilya, thank you so much. It was really very interesting discussion. I keep telling my listeners that I favor these discussions the most for myself because I can utilize time of people like Ilya for hour and a half and ask questions which I'm mostly interested in. So this was Ilya Strebulaev, professor of finance at Stanford Graduate School of Business, David S. Lobel, professor of private equity, and most importantly is my good friend, a neighbor, and advisor to our fund, and Victor Orlovski, managing partner of R136 Ventures, and this podcast, Ventures from the Valley. Please listen and watch us in so many different platforms and enjoy us and put likes. We will definitely enjoy your likes and your friendship and partnership. Thank you so much. Thank you, Ilya.
Victor, thanks so much for inviting me. Anytime. Bye for now.
Ventures from the Valley is brought to you by R136 Ventures. To find out more about R136 Ventures and how we scale mid to late stage startups by unlocking their true potential through investment, visit r136.vc. We will be back soon. In the meantime, make sure to click subscribe so you don't miss any further episodes. On behalf of our team here at R136 Ventures, thanks for listening.